Sabina CPA. I advocate less taxes and more profits. Today, I'd like to talk about your year-end tax planning series, part 2. The sixth tip is be tax savvy about school savings and tuition payment. Similar to retirement, saving for college education is very expensive. Hopefully, we are smart and are starting early and have many years ahead of us. This way, we save a little money each year and let the money grow. Are you currently setting aside money in your taxable account to pay for your child's school expenses? You could realize tax saving by opening a 529 education savings account instead. The sooner you do, the sooner earning will grow tax deferred. They will also generally be tax-free when withdrawals are used for qualified education expenses. The government provides tax incentive through the following plans. Additionally, the Internal Revenue Code provides education-related tax credit and deductions take some of the stings out of college expenses, even before the school year starts. 529 plans. You don't get a federal tax deduction for contribution to 529 plans, even though some state allows for a deduction. But the investment in the plan grows tax-free. No tax is due on distribution if the money is applied towards qualified education expenses in the same year. Beginning in 2018, elementary and secondary school tuition were available under the 529 plan. Coverdell Education Saving Accounts, ESAs. Contribution to ESAs are not deductible, but investment grow tax-free until the money is distributed, and distribution are tax-free if used for qualified education expenses in the same year, which is the same as 529 plan. Qualified education expenses for ESA also include elementary and secondary education expenses, in addition to post-secondary education expenses. Difference between the ESA and 529 plan are 1. Contribution restriction. With a 529 plan, there are no income level restriction for contributions. With a Coverdell ESA, if your adjusted gross income exceeds $110,000 for individual or $220,000 for a married couple filing a joint return, you are not eligible to use a Coverdell at all. Another difference between the two is the investment options. A benefit to using a Coverdell ESA is the ability to self-direct specific investments. While you can choose the asset allocation in a 529 plan, you are limited to the investment that our state-sponsored plan offers. With a Coverdell ESA, you can pick a specific investment you like, which is a great option for donors who prefer to have more control over the investment offering. IRA plans. In general, if a taxpayer takes a distribution from any type of IRA account before reaching the age of 59.5, they must pay a 10% penalty on the early distribution and 25% for simple IRAs. However, if they take a distribution from an IRA for qualified higher education expenses, they escape the 10% additional tax. Note, some may owe income tax on portion of the distribution. In terms of tax credit, there is American Opportunity Credit, which enable a claim up to $2,500 per student per year for the first 4 years of post-secondary education. 40% of the credit is refundable. The second tax credit is a lifetime learning credit. If the student doesn't qualify for the American Opportunity Credit, they may be eligible for the lifetime learning credit. Students and family can claim the credit for up to $2,000 in education-related expenses. The last is a student loan interest deduction. Parents and students can take an above-the-line deduction for interest paid on a federal or private student loan up to $2,500. What you need to do now? Start a saving plan suitable to your unique circumstances. Remember to withdraw money attributed to education expenses before year end. And review if there is opportunity to prepay some expenses before year end to claim a benefit. And remember that you are not allowed to claim a double benefit on the same expenses. The seventh tip for year-end tax planning is to conduct an annual estate plan review. The estate tax is still alive and well, so as part of your year-end planning, please review your estate plan and you should update your wills and other documents. Remember, the federal estate tax applies to fewer people now, with the exemption at 11.58 million per individual or 23.16 million per couple. However, please note that this threshold could go back to the previous lower threshold of 5.79 million per individual or 11.58 million per couple in 2025 if no extension is made in the next few years. Given deficit from previous years and certainly pandemic-related stimulus packages, state and local legislature may drastically lower the current 11.58 million threshold. Lastly, the Fed and states may also increase the estate tax rate to be above the current 40%. What you need to do now? One is to establish an estate plan to bypass probate if you can, even if you don't have estate at the higher threshold. Set up a will at the very minimum. Work with your financial and tax advisor to review your insurance needs. And have a conversation and help your aging parents to review his, her, or their financial accounts. The 8th tip for your year-end tax planning is to safeguard your deductions. Too often, people are surprised when the IRS reduces their deductions. Don't let this happen to you. You can work to ensure you can take deduction by keeping great records throughout the year. You will need proof if you want tax breaks for things like charitable contribution, gambling losses, vehicle costs, and travel expenses. If you neglected to track these expenses at the beginning of the year, get going now. What you need to do: start bunching itemized deduction. The standard deduction has doubled, which drastically reduced the number of taxpayers who can or need to itemize deduction on Schedule A. With this newer elevated threshold, taxpayers may consider bunching their deduction every other year to produce a higher deduction over a 2-year period. Amounts you pay for medical fees, property tax, and mortgage interest are deductible in the year you pay them. However, some expenses must exceed a percentage of your adjusted gross income, AGI, before you receive any tax benefit. For example, out-of-pocket medical costs have to be greater than 10% of your AGI. Do you have less than what you need to itemize? Consider accelerating or postponing expenses when possible to shift the deduction into the current or future year, depending on which year gives you the bigger tax break. And you need to evaluate property taxes. The deduction for state and local taxes is now capped at $10,000. This is something to take into consideration as you plan on paying expenses and deduction. When you prepay property taxes, remember that they are only deductible in the current year if the tax is assessed by the governing body in the same year. Otherwise, they are deductible in the following year. The 9th tip on year-end tax planning is to make the most of your charitable donations. Payroll contribution programs and checks written and mailed to your chosen charity before year-end can get you a tax deduction, as can credit card charges made by December 31st. Donating appreciated stock owned for more than 1 year is a charitable tax saver that gives you an itemized deduction for the fair market value of the stock while letting you avoid the capital gain tax generated by a sale. Keep in mind that as you itemize to claim charitable deduction, a contribution, and you must have written documentation of your donation. Only in 2020, you can donate up to $300 to your favorite charity. For this year only, an above-the-line deduction of $300 is available to all Americans who want to donate to their favorite charity. While you will still need to itemize your deduction if you want a tax break for donation greater than $300, this break helps alleviate the elimination of the charitable deduction for most taxpayers. Please note, $300 is the maximum above-the-line deduction per tax return, regardless of filing status. Also in 2020, you can donate up to 100% of your income. The normal contribution limit of 60% of income is suspended for 2020, allowing you to contribute as much of your income as you want to various charities. What do you need to do now? Is to make contribution by December 31st, 2020. Get receipts for this contribution. For the special contribution above, you must receive a written acknowledgement from each charity you donate to before filing your 2020 tax return. The 10th tip is to harvest capital gain and losses. When you have more losses than gain, up to $3,000 can be used to reduce your ordinary income. With careful planning, you can take advantage of this loss amount each year. Harvest these capital losses by selling off positions with unrealized losses to offset taxable capital gains. At the same time, harvest capital gain by selling long-term capital gain to fill up the 0 or 15% tax brackets. What you need to do: 1 is to rebalance your investment portfolio and take any final investment gain and losses. The 11th tip is consider other savings opportunity. If an employer offers a flexible spending account plan, take advantage of this tax-deductible spending by setting one up. If you already have an account, try to use up the fund by year-end or before the end of the grace period. Year-end is also a good time to identify what automatic monthly expenses should be reduced or eliminated. You may also discover billing for services you thought were canceled. This specific review often catches error that a simple account reconciliation may be missing. What you need to do: set up and contribute to a flexible spending account, and to review automated billing transactions for less minor spending and for more saving. Last but not the least for year-end tax planning is to organize for a stress-free life. Who doesn't want to have less stress, right? Not to mention being helpful to your friendly CPA tax preparer. Help yourself by helping us. What you need to do: start collecting and organizing your tax records to avoid scramble come tax season, such as W-2s and 1099, and to keep these records with prior year tax returns. You also may consider investing in a scanner to maintain record electronically. If you find this video useful, please click on like, subscribe, and forward to those who may also benefit from this tutorial. Please also head to basecpaplus.com to sign up for our email newsletter full of tips for less taxes and more profits. Until next time, God bless.